Welcome to Stockwatch. I'm Simon Brown. Joining me to unpack stock-related questions from yourselves today, Alex Duys, Umthombo Wealth, Chantal Marx from FNB Wealth and Investments. Be sure to send some questions through email, stockwatch@bdtv.co.za, via X using hashtag Stockwatch or SMS 41392. Lady, gent, appreciate your time today. I'm going to say a happy 2025, but I think today is the last day we can reasonably say it. Chantal, we chatted a lot last year. You were cautioning that the rate cutting cycle might be a lot shallower than many were expecting. After jobs data out of the US on Friday, 4.1% unemployment, 250,000 new jobs. I mean, do we even get rate cuts, or what's the story in your sense?
Well, the consensus call is still for 2 rate cuts, but we have started seeing a lot of movement from individual analysts and economists over the last couple of days. And there are 2 big broking houses in the US that have actually said, no cuts, we are done. So I think that this calls into question the prevailing narrative prior to the jobs data, which was we're going to see another bumper year for US equities, and that kind of trade has been super crowded. So it's going to be an interesting few weeks because of this.
Alex, I mean, the key thing with that jobs data that comes out, yes, equities sold off and the like, but man, it's telling us the US economy is doing just fine.
Yes, agreed, Simon. So, I mean, if the US economy is continuing to do well, you don't need to overstimulate it any further, right? So that is the argument why there is probably interest going to be a bit more stickier. We're also in the same camp. We haven't really believed that it will be a steep interest rate cycle, and we're starting to see that. I mean, especially if you compare that to what expectations were perhaps 6 months ago, right? So even though the market is still penciling at about 2 cuts, they were perhaps looking at 4 or 5 cuts a few months ago. So it's been a big shift there, a big pivot, and we've risked it upside, as Chantal says. So for us, we think, it's probably not going to be a tailwind this year for us, interest rates, and it will have quite a big impact on countries like in Europe, where they need to cut rates. Even South Africa could argue we need to cut, but if the Fed stops cutting, it's going to have a bit of a knockover effect on other countries.
Yeah, and I remind you, this time last year, I think we were talking 6 rate cuts last year. It was crazy talk. But Alex, staying with you, does that also mean that maybe at best we're going to get 1 or 2 cuts from our local MPC?
Yeah, well, they're so hawkish, Simon. If there's no cuts, then I won't be surprised if there's no cuts either locally. But most likely, yes, we probably will see a cut or 2. We do have room to do so. If you look at our real rates, it's still quite high. It's a bit of an impediment to our growth, and we'll certainly do require it. I mean, South African consumers under pressure, and if you do want to see that economic growth ticking closer to 2%, then I would think interest rate cuts is a necessity, therefore.
Chantal, does that take some of the wind out of if we see, I mean, even just 2 cuts this year from our MPC, maybe only 1, some of the sort of consumer stocks, and I'm thinking the clothing retailers, you had a storming 2024, might find it heavier going this year?
Yeah, certainly there won't be the interest rate tailwind, or perhaps not to the extent that we expected. But if the rand can pull back a little bit, then inflation will probably remain quite low. And then you also have the confidence tailwind that I don't think we should underestimate. The South African consumer and businesses alike haven't been confident for a really long time. But towards the middle of last year, or from the middle of last year towards the end of last year, there were several things that made consumers feel a lot better about their financial health and their financial prospects, being those interest rate cuts, being lower inflation, but also being a calm political transition in South Africa, along with us having electricity. So these factors cannot be overestimated in terms of what they do for consumer confidence. And consumer confidence, high consumer confidence, or improving consumer confidence equals spending.
Yeah, I take your point on that. Let's move to some numbers. Chantal, we saw Life Healthcare make an announcement early this morning. They're selling life molecular imaging for some 14 billion, potentially T's and C's, of course. Their market cap's only around 24 billion. They sold Alliance Medical Group last year for a special dividend. Your thoughts on the deal and your thoughts on Life Healthcare, assuming that the deal actually happens in the end?
Yes, so the deal's not entirely surprising. I mean, after that Alliance Medical we knew that they were thinking about perhaps selling out of Life Molecular Imaging, which is more an internationally focused business and on the diagnostics front, whereas they are more focused on their hospital group in the Southern Africa region now. I think that the deal was probably at a fair value. It's going to give us a really nice 10% dividend yield if they get that initial cash payment, and as they indicated, they return it to shareholders. And the nice thing for Life is there's going to be an earnout as well. So for the next few years, they're going to get a portion of the revenues that are being generated by Life Molecular Imaging. So quite a positive thing, I think, and I think it will help with management focus. That business is highly cash generative. They haven't been producing the returns that they have in the past, so I think that there's a lot of work to be done, but hopefully the narrow focus can help them get there sooner rather than later.
Alex, Life Healthcare, I mean, we've got an ever-shrinking sort of healthcare hospital sort of sector on the JSE. Your thoughts on the deal and Life Healthcare post the deal?
Yes, I think obviously you have to look at two components to it, right? So first you look at the actual deal announcement, which is positive because it means money back to shareholders and perhaps a bit more focused group going forward. We know Life Healthcare, of course, we're always looking for a partner in these type of businesses. So, that's, I think, as expected. But the problem is now, post LMI, you're sitting with a low growth profile. As you alluded to, South African healthcare sector hasn't really grown very much since 2011, 13, because our GDP per capita hasn't grown. So, the number of medical insured lives doesn't really grow in South Africa. So it's very, very difficult. And you really need to see sustained economic growth of, call it, above 2%, for, I think, for demand to really increase, or affordability to be where it needs to be. We still, of course, got the NHI risk overhang that's, I think, is going to probably prevent these stocks from reaching fair value. And the risks to that, unfortunately, still is to the downside. So for me, it's a good deal. I mean, they continue to unlock value. You can see it in the share price, but it makes it a bit more difficult if you want to be a new investor from here on onwards. I still have some question marks.
I take your point on that. Some questions coming in. Question around gold. With inflation seemingly perhaps not over, Alex's question is there still an investment case for gold? Should I buy the physical ETF or perhaps a gold miner?
Look, so I mean, if you look at gold, there is still a lot of tailwinds for it. So obviously geopolitical risks still remains here. Just because it's a new calendar year doesn't mean the risks are away. If anything, you look at some of the problems in China at the moment with the bond yields dropping, something is telling you something's happening in China. That probably increases the risk as well of China looking to do something over Taiwan, for example. So I think that issue is going to remain there. And then, of course, all the fiscal discipline we've had over the last 16 years. A lot of countries are struggling with debt. Currencies are going to lose value, and that's why inflation will probably not come down further. So all of these factors, I think, plays in favor of gold. But with gold, every time you tend to buy at the peak, it does reverse. So it is one that very difficult to time and so forth. And I'm unsure where it's going to go to, but I do see a lot of tailwinds forward. That's probably a good place to be.
Yeah, it's my story of gold. I'm the bad omen for gold. Chantal, investment case for gold and perhaps gold miners. Obviously, miners more leverage, but I mean, gold had a great 2024.
Yeah, and I think you need to look at gold in the context of portfolio construction. You have a small-ish allocation, not probably more than 5% allocated to gold in terms of your entire portfolio. And it is a nice diversifier because of that safe haven appeal. There are still tailwinds, as Alex mentioned. I mean, one of the tailwinds that I really like for gold is the fact that central banks have been buying up gold at a massive rate. And a lot of that has to do with some of the geopolitical tensions that we're seeing globally. The Russian central bank started it, and the Chinese central bank is continuing it. So I think that support definitely is there. We haven't really seen the ETF flows yet. So I think that could also be a potential further tailwind for gold. But that said, I do think that there's more upside in the gold miners than there is in gold itself. And that's just because gold has been at very high levels for a while. So a lot of these companies will be printing cash currently while their operating costs increase in line with inflation. So that's a lot of additional free cash flow. Some of them have run really hard, like a Harmony, but some of them have lagged, like a Pan-African Resources. So I'll probably stock pick within the gold space if I'm looking for, or the gold mining space if I'm looking for gold exposure.
And would that stock be Pan-African Resources? Because I mean, they've done that deal in Australia, but they're still a great little mine.
Yes, absolutely. And I mean, the deal in Australia we've spoken about before, they didn't bet the house. They dipped their toes previously in that operation, and they're very good allocators of capital generally, and they do tend to be quite careful in terms of spending any money on acquisitions or expansions.
Question coming through around banks with interest rates not coming down as much as expected in 2024. Bad debts perhaps a risk there. Is Nedbank worth having a look at? Chantal, how about our local banks? How about Nedbank in particular?
So I think that the risks are balanced for banks at the moment. I don't think that the interest rate cycle at this point in time is going to have a major impact. So the big reason why I'm saying that is that when rates come down, net interest margins kind of contract, but net interest or non-interest revenue, transaction fees, and all the rest of that increases. And there's a bit of a trade-off when it comes to that. So I think the fact that we could see rates bottoming pretty soon, or they are already at a bottom, I don't necessarily think is going to have a big impact on the banks. I think most of the banks have been very conservative in lending criteria in this specific cycle. So I don't foresee a massive increase in bad debts from here on out. I actually see things stabilizing or improving for the banks. They have run hard, most of them, but I think that there is still some value in most of the SA bank names. Nedbank, being the smaller of the lot, has lagged, so I think that there could be a bit of an opportunity there. I mean, we basically like most of the banks still, so I don't think you can really go wrong.
Alex, local banks, Nedbank in particular?
Yeah, I concur with what Chantal just said. There's perhaps the easy money has been made on the banks, but they're still very geared to any form of economic growth activity we can get here. So, for example, if we do get to 2% GDP growth and the banks can deliver high single digits to low double-digit earnings, then it's still attractive. So Nedbank obviously got a bigger exposure to corporate. So if corporate asset does invest more specifically in renewable energy projects and so forth, they will be a forefront of it. They've got less exposure to retail compared to, for example, like an AfriSam. So I think that's one way to look at it. We think Nedbank is relatively attractive. It also don't have that's much exposure to Africa, where there has been some headwinds, and that's been impacting, for example, Standard Bank share price of late, and also doesn't have exposure to the UK, which has obviously had an impact on FirstRand. So Nedbank for me is in the middle there. It looks relatively attractive, and we own it and we like it.
Before we go to the break, question coming through around AfriMat regarding the ArcelorMittal potentially, or they've said that they are going to close their plants down in Newcastle. Alex, AfriMat supplies the iron ore. It's certainly important in their life. I mean, should we be worried? I mean, I think Lafarge is perhaps the bigger deal and kind of getting that on stream. Your thoughts on AfriMat in light of the ArcelorMittal announcement?
Yeah, look, I mean, the risk of ArcelorMittal has always been a bit of an overhang on AfriMat. Initially, when they announced they got problems there the fourth year, you saw the impact on AfriMat share price. Then made a recovery. Now we're seeing once again weakness. So it certainly will have an impact. AfriMat will probably have other options to consider, perhaps the export market and so forth. I'm not too sure, but obviously from a local market perspective, isn't really that much substitution available for someone like ArcelorMittal. So it's certainly a headwind for them. But yeah, I'll probably agree that Lafarge is, at this moment, the execution of that is probably more important, because I think a lot of investors are quite circumspect on the prospects of iron ore. So for those that are circumspect about it, they're probably not involved in AfriMat. They probably have exposure to other shares. So I think for AfriMat shareholders, they need to execute on Lafarge as well as Inkomati, get returns back there, get the balance sheet where they need to be again, and then perhaps look at reassessing further new deals. We do think AfriMat's an attractive long-term investment case, but will not go up in a straight line. You will see volatility and you will see headwinds like we saw the last H2 and we'll be probably experiencing in a month.
I mean, is the ArcelorMittal that big a deal in the life, or as Alex was suggesting, perhaps getting Lafarge going right is more important?
Yes, I think that it will have a near-term impact just because of the kind of take up agreements that they would have had in place that they'll have to replace. So it's more a logistical nightmare, I think, than a long-term issue, because they do have alternative markets for that iron ore. As Alex also mentioned, they could look towards exporting that product. And then, of course, they'll also still feed into ArcelorMittal's flat steel business. It's the long steel business that's closing, but ArcelorMittal will still have a sizable steelmaking business left in Vanderbijl Park. So I think that those options are out there. And yes, Lafarge is the biggest execution risk for AfriMat right now. When we spoke to management, I think at the end of November, they indicated that most of the operational issues that they had at the Lafarge factory was solved, more or less, and that they were starting to see an improvement in their overall group returns profile. So I would expect us to get to their kind of sector-leading returns on capital investment pretty soon. And I think that that's going to be it's going to be what underpins the investment case for AfriMat, which we also still like.
Yeah, no, it's certainly Andrew van Heerden at results was optimistic that Lafarge was going in the right direction. Chantal, staying with you, a question came through around leisure stocks. We've seen varying degrees of sell-off, and some of them, particularly Sun International. Is this sell-off an opportunity for our local leisure stocks? Your point earlier around consumer confidence, if we're spending, some of that's going to be holidays.
Yes, absolutely. So I think that there's value in Sun International. I think there's value in City Lodge. I think Southern Sun has run quite hard over the last year or so, but I would even be comfortable remaining invested in that stock right now. It's not only a local travel story, but also an international travel story. And I think South Africa as an international tourist destination has really come to the fore over the last few years. I mean, you open an app like TikTok, and every second TikTok that you see is a foreign person coming to Cape Town or to the Kruger and talking to the world about their fantastic experience. So I think that these stocks generally could do quite well. The third leg, I think, is also a real resumption in business travel. I mean, I don't know about you guys, but in the last year, I've traveled the most since I've traveled for business since prior to COVID 2019 kind of calendar year. So definitely that picking up as well, and that should aid the likes of Southern Sun and City Lodge in particular.
Yeah, certainly. And my travel for this year is going to be, as you say, way back to pre-pandemic. Alex, your take on the leisure sector? There has been a bit of a pullback. Opportunity here for the local stocks?
I would certainly agree there's lots of opportunity there. I think slowly but surely starting to see corporate travel get back where it needs to be. So that'll obviously be a tailwind for all of those counters. I think tourism, if you look at the weak rand at the moment, obviously is to their benefit, but that gives them quite strong pricing power. So, for example, something like a Southern Sun can easily increase their prices in rand terms 10, 11%, and in dollar terms barely has an impact. And it's still extremely affordable compared to other countries. So South Africa, I still think it looks quite good from there, and it does give pricing power for some of these businesses. And I think that shouldn't be underestimated, especially as you fill in capacity. Regarding Sun International, so they're not going to proceed with the Piedmont deal, which I don't think is a train smash. Now they probably will continue to focus on paying down debt as well as giving excess cash back to shareholders, either through higher dividend or through special dividends. And we think that's a good place to be in the moment while they're still benefiting from strong operational growth. So I think it could do a lot worse than buying any of these counters in the leisure sector.
Question came through from Clyde. He's asking around Naspers and Prosus. He's got a two-part question. He says, is there a preference between one or the other, or are they broadly the same? And are they still worth continuing to hold for 2025? Of course, we got Alex, Department of Defense, out of the US, claiming that they were working with Chinese government, putting them on a watch list. They're not banned in the US, but your take, Naspers versus Prosus, either or?
Yeah, so the last, call it 10 years, whenever you invest in Naspers Prosus, always some form of operational risk that comes up. And now we recently got the one you just alluded to, which is a bit of a surprise and obviously has had a big impact on the share price. Now, what I've been able to gather thus far, it doesn't seem to be that material, but you never know. I think for me, the big concern is if American investors aren't allowed to buy these shares anymore, what impact it will have on the flows and obviously the rating of the stocks. But for the time being, it does seem more of a knee-jerk reaction and probably a bit of opportunity. My views still remain that I'm very positive on Tencent fundamentally. I think they've got excellent prospects. They've still got a lot of associate stakes they can sell or realize value on. They continue with the share buybacks. On top of that, you've got the Naspers process also doing the share buybacks. If you don't have any exposure yet, my preference would be for Prosus because it's closer to the underlying asset. But if you do have a Naspers, don't take the tax impact to make the switch and so forth. But yeah, that's pretty much my view on it. I still remain relatively confident, but be cognizant you do have these risks that emerge every now and again. And if you do see big moves in tensions in the US-China, they could also have a bit of impact on sentiment, perhaps sanctions, whatever the case might be on investment. So that risk, unfortunately, won't go away for this year.
Yeah, and Trump 2.0 presidency starts Monday, so we'll find out more then. Chantal, Naspers process, Tencent, ultimately, your view on them, investability?
Yeah, I mean, I'm still positive on all three stocks. The important thing to remember about the Tencent list story is that there are two lists. And Tencent is on the not so bad list.
Yes.
And they even disputing that list. So they are adamant that they are not in breach of any of the conditions of being kept off of that list. So they will continue to push forward. As Alex mentioned, there's a lot of corporate activity that can unlock value for Tencent shareholders. And then similarly, within the Prosus stable, there is also a lot of corporate activity that can unlock value. They're making acquisitions. They are selling some of their more mature assets. All of these things have a positive impact from a valuation perspective or valuation unlock perspective. Just as an example, Prosus owns a stake in Delivery Hero. Delivery Hero recently listed their Middle Eastern business. So now there's a way of finding out what that Middle Eastern business is worth. Now we know what the business is worth. Delivery Hero's valuation reflects that, and Prosus's valuation reflects that as well. So these are interesting ways in which to unlock value. I think the stock is materially undervalued still, and that's why they continue to buy back shares. So yeah, I mean, I would prefer Prosus as well, just because it's closer to the assets. But as Alex also mentioned, I don't think you'll do any worse being invested in Naspers.
Question came through around Exxaro, and I actually happened to see a chart earlier today talking around coal exports and showing that a lot more coal going out of Australia, going out of India. Chantal, Exxaro, I mean, they've got the good asset. Of course, they've got the challenge of Transnet. Is there opportunity here? I mean, in time, coal will fade, but we're probably a ways from that. We're still predominantly using coal as our energy resource.
Yeah, so I think from the very long term, there is probably, well, let's counter that and say from a medium-term perspective, I see value in Exxaro, right? Very long-term, coal will probably be phased out. Near-term, I don't like boardroom drama, Simon, so I will just stay away from the stock as long as we have uncertainty around who's leading the business, what's happened in order that resulted in this blow up at a boardroom level. I'll stay away. But I think that the assets are decent. The fact that they're exporting more now, rather than selling into the domestic market, even though they're still doing that, I think could be quite positive from a margin perspective. And they've been excellent in terms of delivering cash to shareholders. So yeah, I mean, medium term, yes. Long term, no. Near term,
fix the board. I suspend or do something with the CEO. Alex, your take? I mean, certainly having a suspended CEO is never a good position. Exxaro?
While there are corporate governance issues which shouldn't be taken lightly, I do think there's also risk when it comes to capital allocation. So they're looking to do some form of deal. Initially, they look globally. I think they shortened it down out to looking from local manganese assets. And then obviously running as assets. Now, Exxaro doesn't have a great track record of running assets. I'm a bit concerned about what they could buy there. So that's something to think about. But saying that, the share is incredibly cheap. And it is quite an option also if you do believe in a recovery in Transnet. So I think it'll be quite geared to that. So any form of positive sentiment on news could also obviously lead to quite a lot of re-rating in the stock. So yes, it's a bit of a binary outcome in a moment, but I do think on a balance of probabilities, there's probably more to like than not to like here, in my view.
Yeah, and I like your point around Transnet, and certainly they did a little more last year than they'd done the year before, and perhaps we can start to improve on that, and there's some benefits to that. Let's go to some stock picks. Alex, you're going with Bytes.
Yeah, so for those who are not familiar with Bytes, it means it's a leading pure play software value-added reseller in the UK, right? focusing on SMEs as well as the public sector. Another way to think of it is pretty much a direct play on cloud, AI, and security for those that only invest in South African or JSE market. Another thing to consider is that Bytes prospects are directly aligned to that of Microsoft. So obviously if Microsoft does well, Bytes will benefit. And at the same time, Bytes is looking to increase the number of vendors as well as expanding the service offerings. So I think that will add to the investment case over time. In our view, Bytes is a good quality company. It offers good growth potential, and a lot of the earnings is backed by cash flow, which is also very important for us. And I think the reason why it's on my radar now is the share price is down about 30% over the last year. And I think it offers a good opportunity to buy, as we like the underlying investment case.
Bytes for Alex. Chantal, Bidcorp.
Yes, so we really like Bidcorp from a long-term investment perspective. We view it as a core portfolio holding, and the stock just looks cheap. So it's trading on a forward P of about 16 times, relative to a long-term history of about 19.5, 20 times. We think an elevated rating is justified because the company has provided excellent return on invested capital over time. They are really skilled in making bolt-on acquisitions, embedding those bolt-on acquisitions into their business, and growing both in that way as well as organically. Food service isn't generally regarded as a defensive sector, but if you look at this company's cash generative profile over the last 10 or 15 years, it does look like it is more of a defensive business. Stock has underperformed over the last year, returning over only 4% relative to the rest of the market, firmly in the double digits. So we think it's a really good opportunity, and the technicals also stack up. The stock has consolidated quite nicely around its 200-day moving average.
Perfect. We'll leave that there. That's all for Stockwatch tonight. Thanks to our guests, Alex Stace and Umthombo Wealth going with Bytes, Chantal Marx, FNB Wealth and Investments going with Bidcorp. Coming up, the close. Stay watching.